get started. So today it's an interesting topic. We're going to talk about money and banking. We're going to talk a little bit about the details about what actually money is. So we're going to describe the functions, characteristics, and history of money, and then we'll explain what is and what's not money, and also describe the main function of modern banks as money lenders. And then we'll talk about how a small amount of cash can support many loans and create more money. So we'll introduce the money creation process. So what are the functions of money? So the first is a medium of exchange. So it's an intermediary used to avoid the inconveniences of a pure barter system. So what's a barter system? Can anyone type that in the chat function? So if you didn't have money, how else would you trade? Well, you'd have to exchange goods. Now you can immediately think about how inconvenient that was. You know, if I wanted to buy a computer, I need to find someone who has the computer I want, but also have, I'd also have to have something that they would want and in the right quantities. So it's a very inconvenient way of exchanging goods and services. You can imagine the amount of economic activity that wouldn't occur because of such a system. So money is a really, really useful. It's one of its most important functions is that it's a medium of exchange. So because if we didn't have money, it would be very, very tedious to do any trade. And that's where our wealth and that's where value comes from. And so there'd be much less of it without money. Another important function is that it stores value. Typically, you can save your money and transfer purchasing power into the future. You can keep it under your mattress or whatever. And if you put it in the bank, then you get a bit of savings on it, maybe in the form of interest. So it's a store of value. This function of money would not be if, for example, the government printed too much money and you had very high or hyperinflation, then this wouldn't be that great of a function. But for the most part, it's an important function of money. It's also a unit of account. So if we think back to our barter example, how would we do accounting? How would we write down the value of something? If you're a business and you're selling stuff, what's your profit? There's no money, so how do you write that down? It'd be it's not possible. You'd have to write the value of everything relative to something else. If you had a business selling tables, then you might have to, I guess you could pick some other good relative to that and say, okay, well, I've made this, from the sales of tables, my worth would be something like how much chairs I could buy, but you could any good would work as something relative to that. So again, it would be very difficult to do any sort of accounting. So money provides a unit of account. So we can write the value of everything in dollars because we use the dollar as our money in Canada. So we'd be able to we can record debt, we can do our proper accounting, etc. So these are the three most important functions of money, the three main functions of money. Now there are also characteristics of money. We'll talk about those in a moment. Just to start with a question. So, if you have a $10 bill from the Bank of Canada, why is that considered money, but money from the Monopoly game isn't called money? Real money. Anyone type in the chat why that might be the case? Well, the main idea is acceptability. And so this is actually the most important characteristic of money. So don't confuse the functions and characteristics. This is a characteristic. So despite any of the other characteristics that we'll learn shortly, if this one doesn't hold, then it's not money. In order for something to be money, any object, it has to be generally accepted by everyone. So yes, socially defined sounds like a good answer, Michelle, something along those lines. We just, all of us collectively need to accept it. We all accept that whatever object we could think of we all accept it as payment for goods and services, then it's money. So it has to be generally acceptable. If it's not, then it's not money. Another important characteristic, as someone in the chat just mentioned, relative scarcity. We'll get to that in one sec. That's a extremely important one. So acceptability, let's just spend just a second on that. There's this thing called legal tender, and that's the government declares the Canadian dollar in Canada is legal tender. That just means that the paper currency must be accepted as a payment of a debt. Okay, so that, I mean, generally though, the only reason why the Canadian dollar, that are the bills that are printed from the Bank of Canada, considered money is because we generally accept it. Legal tender gives it a little more strength, but it's not that the strongest thing. It just means in a situation where there's a debt, the lender has to legally accept the Canadian currency to settle that debt. But when you go into a convenience store, you don't have debt with them. The convenience store clerk doesn't legally have to accept your money, and that's why a lot of times they don't, because they're worried about counterfeit $100 bills. So they say we don't accept those. But really, it's just general acceptability. Our currency isn't backed by any precious metals. That was gone a long time ago. The main thing is that we generally accept it, and again, this legal tender helps strengthen that to a certain extent. But if we had a government that we didn't trust, or we were a little worried about what sort of financial policies they're going to make, we may not actually want our own money. And then sometimes there are countries where I've been to Costa Rica, and there they accept the US dollar just as much as their own currency. So sometimes a country, there could be situations where their currency maybe doesn't have as much acceptability, and they may use something like the American dollar. But the main idea is that anytime, to call something money, it must be generally acceptable. And relative scarcity is also very important. So you wouldn't use sand or something like that that's very abundant as a form of money, because it's so abundant it could never really hold much of its value. In the past, this is why gold and silver, these precious metals, were commonly used as money, because they were relatively scarce. And so they will always have value. Again, this is why the government doesn't want to, or makes it illegal to make counterfeit our currency, because that makes it not relatively scarce. If we used the Bank of Canada printed bills where they were just like a white piece of paper with a laser printer, and everyone could create these things, then obviously they're not going to have any value. So relative scarcity is very important, and it should be durable, right? You could probably have money that's maybe not that durable, but then it wouldn't really store as a function of value. So you wouldn't want to use any type of food. To make things convenient, you'd obviously want it to be portable. So big objects like boat anchors or big stones. Although in the past I've heard of stories of big stones being used somewhat as money, but it was obviously very inconvenient. But again, as if it's generally accepted as money, then it can be money, right? These are just sort of would make it much better. Whatever object you're talking about would be much better if it had these characteristics. And you would like it to somehow be divisible so you can make change, so you can get different amounts. So that's, so there's these characteristics of money and then the functions of money. So make sure you know those. And, if you need to know the difference between the functions and what are characteristics, and especially what's the most important characteristic. So just as an example, back in the 17th century in New France, the colonists ended up using these cards that are seen in the photo here as money. I guess the main idea was that they had a shortage of actual coins at the time. And it says that here somewhere. So the supply of old world coins was becoming hard to get, and a local governor eventually signed off on making playing cards legal currency in New France. So the soldiers in this colony were using these playing cards as money. Eventually, they were going to redeem the cards for actual coins, but in the meantime, they were used as money. They fulfilled those functions as a medium of exchange, especially. And some of the reasons why these cards were useful as money was that they were quite rigid. They were made of really stiff paper, and the backs were blank, and so the value was written. They were able to write that on the back and be able to have the officials sign their names. And then they cut them in different shapes to represent different value. And then, the merchants were encouraged in that colony to accept the playing cards as payment, with the promise that they would be exchanged for gold or silver coins when that shipment eventually arrived from France. So it's just, I thought it was a good example of an object being used for money that we haven't really seen before. Now we're going to talk a little bit of history, just how sort of the first bank came about. And the first bankers were, in fact, goldsmiths. So the idea is very straightforward. So in medieval Europe, banking started from goldsmiths. Why goldsmiths? Well, goldsmiths would provide safekeeping storage. So they would provide, a vault or something like that for people to keep their money safe. And especially back in those days, if you had accumulated a good amount of wealth and you had it in gold, you kind of don't want to have that in your house. You could be a target for theft and robbery. So goldsmiths provided a good function, a good safekeeping function. So a lot of people would store the gold with their local goldsmith. And what the goldsmith would do was they would issue a promissory note or a receipt for a certain amount of gold. So it's basically like an IOU. So you would go deposit your gold and you get this piece of paper that gives you claim to gold from that goldsmith. And so that's a promissory note. So yeah, that was an example of one. As more goldsmiths began to issue these receipts, it became possible to take a receipt to any goldsmith and cash it in. And then eventually the receipts began to circulate as paper money. And why would they do that? Well, just think about it. If you want to do a transaction, so you want to buy something, you got to go to the goldsmith, withdraw your gold, give it to the person you're buying the goods or services from. They're going to take the gold and probably go back to the goldsmith and deposit it. So why do you need to do all of that? Why not just trade the receipts? And so when this became widely spread and the receipts themselves just circulated as money. They were backed by gold, but you don't need to actually get the gold to do the transaction. You have this receipt. So this is the main idea. So when you think of that's where the word note comes from, as like a promissory note. And it's based on the idea of these types of receipts that were backed by gold. And we can take this a step further. So now we're going to talk about fractional reserve banking. So again, think of the goldsmith. They have all this gold in their safe, and then they have a bunch of receipts that are circulating around that are laying claim to that gold. But not everyone is coming all at once to get their gold. So the goldsmith can actually just create money out of thin air by just making more receipts. And as long as everyone doesn't come get them all at once, they're fine. And that's essentially what our banking system is today. It's a fractional reserve banking system, except we're not talking about gold or silver. It's just about the money itself, the money that the Bank of Canada prints. So also, just to note, they're not just going to make receipts. Like if they can make extra receipts, but who are they going to give them to? If they wanted to create, if you're thinking about this idea of creating money out of thin air, they can do that easily by just making more receipts. But what are they going to do with the receipts? Well, that's where the idea of loans comes in. So the goldsmith has all this gold, and it could issue these extra receipts. Why not make some extra money and lend out gold coins from the safe and charge interest? And then, well, that's what they first did, but then next they would begin to lend out the receipts for the gold. Just here's, so they can just create more receipts than the number, then that lines up with the amount of gold that they actually have in the safe. So basically money's created out of thin air through lending. And that's exactly the same idea today with fractional reserve banking. That's why you'll hear that sometimes on the news. They'll increase the money supply. The central bank can do things such that the commercial banks will have excess reserves of money and want to lend it out or do something with it because they don't want it to sit around. And when they make a loan, essentially they're creating money out of thin air. And we'll talk a little bit more about the money creation process in a bit. So that's the idea of where banks came from and fractional reserve banking system. It's just the main ideas. So it's kind of interesting and it makes a lot of sense. So this is just a slide for you to have. I mean, it just goes over the story I just went over. I put this in for your notes when you're looking over the lecture notes. So you can read this as a good summary. So So just some terminology notes. So a bank note is a type of negotiable promissory note made by a bank payable to the bearer on demand. So again, think of the idea of the Goldsmith, those receipts. Those are basically promissory. Those are promissory notes or IOUs, you can call them. Another word is just a bank note. So eventually it wasn't Goldsmiths anymore, but at some point we had regular banks now. They did a lot of regular banking functions, but they still issued these type of IOUs, and they were based on gold or silver. So banknotes were originally issued by commercial banks. So what's interesting is it's not just the government. So back in, say, the 1900s, any bank could issue a banknote. So you could have the Molson's Bank, the Bank of Montreal. You would have in circulation banknotes from all of those different commercial banks. And so, you could go into a cafe, purchase a coffee with one type of banknote and get change in another type of banknote. And so that's how it was. It was not until the 1930s when the Bank of Canada was established and they became the sole issuer of currency. So, and then they removed anything other than the notes in circulation, anything other than the Bank of Canada. So it wasn't, commercial banks weren't allowed anymore to, make their own banknotes. So, but again, in this period where these notes were backed by some sort of gold, okay? So that changed. The money we have now is called fiat currency, and it has nothing backing it. There's no link to gold or anything like that. It's just, again, has any value because we generally accept it, and then there's a little bit of strength to its acceptability provided by the legal tender, by declaring it legal tender. So these are some of the these are some commercial banknotes. So this is the Royal Bank of Canada. So this was a $5 banknote, and if you could look here somewhere, it says we'll pay to the bearer on demand. And this was for something like gold. So it was actually not until 1944 where commercial banks were prohibited from issuing their own notes. And so this is one of the last issues of the Royal Banks, the Royal Bank. This is an example of one from the Bank of Montreal. Again, it always has on there somewhere, we'll pay, in this one, pay $4 to the bearer on demand. This is an example from the Molson's Bank. And, it says, so whoever's holding this is eligible to that gold that's the bank would have for them. So this is just a Huffington Post article that I found. And, it's just going over what I was talking about before. If you could imagine back before, maybe 1910 or something like that, walking into a cafe, buying a drink with a bill from Molson's Bank, and you would get change in the form of a Bank of Montreal bill. So this is actually the way things were up until 1935, and that's when the Bank of Canada became the sole issuer of Canadian legal tender. But I think there was about a 10-year period where there were some banks still issuing some of their own, but it was slowly being moved out so that it was just the Bank of Canada. And it's not so much that they just want power. It just makes a lot more sense. There are issues with having multiple institutions creating currency within a country. You could imagine if, say, the Molson's Bank, their management made some really bad loans and there was a news story about how they may go bankrupt. Anyone then who has any money from Molson's Bank would be trying to get rid of it to get other currency. And so, it causes a lot of issues there. People would get hurt pretty badly because they could lose a lot, whatever the notes and coins that they're holding on to, they could completely lose their value if that bank goes out of business. So yeah, and it's similar in the US. I can't remember the exact dates, but around this time they started doing something similar as well. And now it must be a better option if every country has decided to do that, and that's what they've done. Just here's some examples here of the first issues of banknotes from the Bank of Canada. So again, with these notes, it's not backed by anything. After the 1930s, none of this money was backed by gold or anything. So if you brought one of these to the Bank of Canada to redeem it, you would just get another one. There was nothing else backing. So it was by 1944. Although the Bank of Canada was established in 1935. it was more in 1944 where they finally became the sole issuer of legal tender banknotes in Canada. And so just some more historical notes. So in January 1929, Canada ceased redeeming Dominion notes in gold and thus effectively ended its adherence to the gold standard. So that's where we were no longer part of, there's nothing to do with gold anymore. And the word fiat, which is what our currency is called, it's called fiat because fiat is a Latin word for it shall be or let it be done. It's like a decree from the king or something like that. And so we're basically saying that the government is basically saying, this is what we're going to use and you're going to generally accept it. And again, legal tender comes in, it just gives it a little more strength in terms of how, gives a little more strength in terms of acceptability. And again, but this is very limited. It's only in the situation of a lender and borrower. The lender has to accept the currency that's declared legal tender. And so just to clarify some of the terminology again, so the Canadian dollar in Canada is Canadian currency. The reason why we call it currency is because that's what is declared legal tender. A note on that. And so all of the new bills, there was a while where they kept putting "will pay the bearer on demand" on the notes, even though they weren't backed by gold. They eventually changed that in, I believe it was the 70s. And now it just says this note is legal tender. So that's all they put on the money. Okay, so there's some definitions here of the money supply, essentially. Each textbook sort of has kind of different categories. Just pay attention to the main ideas. So for a test or quiz or something, just focus on these main definitions. And the most important one is M1. M1 is basically what can be immediately used to buy something. So notes and coins in your pocket and your bookkeeping entries at your bank, which represent your demand deposits in your checking account. Demand deposit is refers to the fact that depositors can demand their deposit in cash at any time. Okay, so that's checking accounts, even sort of some savings accounts are like that. Like I know my savings account at CIBC isn't really any different than the checking account, but there are different types of savings accounts. There are many different savings accounts where you may need to wait a few days or a week to be able to access your money. And you tend to get a little bit higher of an interest rate on those types of savings accounts. For the most part, what we consider money is just currency in circulation, coins and paper banknotes, and demand deposits. So the M2 definition, so M2 has M1 in it, and then it's just additionally adding things like notice deposits or personal term deposits. So these are deposits where you can't immediately, like in the demand deposits, you can, immediately demand your money in cash anytime and get it. These you have to wait. There's some time element involved. So notice deposits, these actually require you to give notice to the bank before making a withdrawal. These are typically what are called savings accounts. But again, I have a savings account with CIBC and I don't need to give them any notice to take any money. It's almost as if it's my checking account. I'm not even sure what the difference is, to be honest. But there are other types of, which would be called savings accounts, where you would have to give some kind of notice. You can't just access your money immediately. And again, the reason why people might want to have their money in there is because they could get somewhat of a higher interest. Interest rates are so low now that I don't think anyone would consider something like that as a smart place to park money for any extended period of time. They would probably buy maybe money market mutual funds or something like that. But then again, it depends. Businesses sometimes have different needs. They may not be able to do that. So a lot of businesses maybe would have some of these types of accounts, if they just need to park money for a short period of time. And personal term deposits, these are on deposits for a specific term, such as 6 months. So these are a little, there's still a time element, but it's not like the notice deposits. You have to give notice and then you get it. The time period is probably not too long. But a personal term deposit is a deposit where they're not going to let you touch it for a specified term, like 6 months, and then you get your money back. And then we can go further and include certificates of deposits. These are essentially similar idea as this, but this is for business. So these are term deposits of businesses, which are easily convertible into checkable deposits, but there's going to be some time involved to get it. So basically, when we go from M1 to M3, we're just talking about reducing the liquidity. This is about as liquid as you can get. This you can immediately buy something with. This is sort of, you're storing some value here, but there's a time element. It's going to take a little bit of time before you to actually get that and to be able to use it to buy something. Okay, so we can just, in a moment, we'll just practice those quick definitions just to get a sense of the sizes of these types of things. I can't remember what year this was, but it was about maybe 2010 or something like that. Oh, this textbook, the copyright's 2014. So yeah, maybe around 2010, 2012. This shows you the relative size. So if we're thinking about all three of those definitions, that would be this M3. So that would be this entire stack here. Currency, so your coins and notes in your wallet represent a very small portion of the overall M3. It's only, this is probably 65 billion. Demand deposits are much larger, more, maybe 3 times larger. Still, they're quite small when you start looking at notice deposits and personal term deposits. And I'm not sure with the interest rates being so low, maybe this is not as big as it used to be. But this could maybe be GICs as well. I'm not sure if that would be also included. So if that's included, then it would make sense that this would be so large, because that's essentially, a GIC is essentially like a personal term deposit almost, because with GICs, they can sell on the market, like you can get out of one early, but then you have to sell it on the market. So again, you're putting money away, but you can't just get it immediately. So these tend to make up a huge portion, and then also certificates of deposit are, so both of these are actually much larger than demand deposit currency. But we tend to think of this as money because this is what can be immediately used to buy something. Okay, and again, these definitions are cumulative. So M2 includes M1, and then it additionally adds these things. M3 includes M2, and then so it also includes M1 because M2 includes M1, and then you're adding certificates of deposit to that. If you go to the Bank of Canada, they have a number of other definitions. So I don't want you to think too much about this as being set in stone. These are they're not arbitrary, but they're different. The categorizations increased here with decreasing liquidity, but some categories put different. I've seen some with Canada savings bonds in them, or traveler's checks. I don't think anyone uses traveler's checks anymore. So it depends on the textbook, right? But there's lots of differences and slight adjustments in these definitions. But the first one is always pretty much the same. It's currency in circulation and demand deposits. So what do we not consider money? So the currency in the vaults or tills of banks, we wouldn't consider it part of the money supply. Why is that? Well, let's think about someone depositing $20 into the bank. So if we're saying a $20 bill in circulation, like if I have a $20 bill in my pocket, that's considered part of the money supply. I could use it to spend it. Now, if I go to the bank and deposit the money into my checking account, and I'm going to have an entry on, a debit on my checking account, which I can use to buy something. So that $20 in my checking account is part of the money supply. And that $20 bill is going to go into the vault. If we were to also include that $20 bill in the vault as part of the money supply, then we'd be double counting. So that's why the currency in the vaults or tills of banks isn't part of the money supply. Basically, if it's going into the vaults or tills of the bank, it's being deposited, and you're going to have a demand deposit with the same amount in there. If you were to count both, you'd be double counting. We don't usually think of gold as money. I mean, it does satisfy. It is pretty much widely accepted, but maybe not, because some people may not accept it because they don't know if it's true. If you brought in a piece of gold into a convenience store to try and buy something with it, if the store clerk knew it was gold for sure, and it was a reasonable amount, perhaps they would take it, but they can't. That's just not most of them probably would not accept it because they don't know if it's real or not, and they're not going to waste their time for the value of anything in the store to worry about whether, they're not going to lose out on much if they say no. So generally, gold we don't really think of as money, although it does satisfy the functions generally and many of the characteristics, but it's not really widely accepted. Financial securities like stocks and bonds, those you can't use to immediately buy something. We generally don't consider, those aren't money. Checks, credit cards, or debit cards, in and of themselves, they're not money, right? What is a check? A check is just instructions to do a transfer. If I write a check to you, all the check is instructions to my bank to take my money in my demand deposit and transfer it to yours. And that's where the money is. That's the money. The check is just instructions on how to transfer the money. So a check itself it's not money, right? It's just instructions. Credit cards are essentially instructions for the credit card company to lend you money and immediately give it to the merchant when you buy something. So it's still sort of like a form of instruction. Debit cards, same thing. In and of themselves, they're not money, but they're providing instructions on what to do in your demand deposit. So it's more a means of accessing money or transferring it, but it's not money in and of itself. So let's see if you were paying attention. If David deposits $240 cash into his checking account at a commercial bank, has the money supply changed? Anyone want to? Okay, so someone says no. So let's think about why the answer would be no. So David deposits $200. So when David has the money in his pocket, it's part of the money supply, right? As currency. When it's deposited into his checking account, it's still instead of being currency in circulation, it's now going to be a demand deposit. So it's still included in M1. And the money supply, all of the different definitions include M1. So nothing has changed. The only thing that's changed is the composition of M1 from, so there's $240 less of currency in M1, but $240 more of demand deposits. But the overall money supply wouldn't have changed. If later on David transfers this $240 from his checking account to a savings account, same bank, suppose that's a term deposit, has M1 changed? Anyone want to answer that? M1 will be less because the money now is not going to be in either currency or a demand deposit. It's going to be in a term deposit, like a savings account, which is included under M2. Okay. But would M2 have changed? So M2 won't change because it includes M1. If M2 was just the term deposits, then yes, it would increase. But remember, M1 includes M1. So what's going on is, you have a reduction in M1, but M2 includes M1, so it just cancels out, right? So the $240 goes from the checking account into a term deposit. So if you're thinking about M1, well, that money has left the M1 because it has for it to be an M1, it has to be either currency in circulation or a demand deposit. It's not in those anymore. It's in a term deposit, and term deposits are under M2. But M2 also includes M1. So one part of M2 increases, that's term deposits. The other part of M2 decreases by the same amount, which is associated with M1. Okay, so there's going to be no change in M2 because, it also has M1. So there's going to be more notice deposits, but now there'll be less demand deposits by the exact same amount. So if we're given this information, let's calculate the different categories. So we're told coins are $13. That's in billions, so 13 billion. There's $137 billion of certificates of deposit. There are 72 billion in demand deposits, and there are 215 billion in notice and personal term deposits, and there's 27 billion in notes. So what's the value of M1 here? Anyone want to type that into the screen? So M1 will be coins, right? Will it include certificates of deposit? No. It'll include demand deposits and it'll include notes. So it'll be 13 plus 27 plus 72. And so it'll be 112. What about M2? So what is M2 going to equal? That's right. So we're going to additionally add to the 112 the notice and personal term deposits of 215. And what is M3? M3, we're just going to add the certificates of deposit. So now let's talk about the money creation process. So again, you remember back about the Goldsmith. The Goldsmith could easily create money out of thin air just by making loans. And so someone who needed money, maybe it's a small business in the community, they go to the Goldsmith, and the Goldsmith can issue them a new receipt. That receipt now could be, if you took all of the receipts in circulation, there would be more than what the actual amount of gold is in the safes. And so basically the Goldsmith can create money out of thin air just by making a loan. So the Goldsmith would just write up another receipt, give it to that person, but that person has to give the receipt, that receipt back with some interest. I'm not exactly sure how they did the interest thing back then. Maybe they just tacked on some actual real gold with returning the receipt, but that's the idea. And so with the banking system the way it is now, we're not talking about gold, we're just talking about money itself, the legal tender currency. And so, when a bank gives you a loan, so say the CIBC provides a loan for you, what do? They debit your checking account, and they're just basically putting a bookkeeping entry in, that's all it is. But you can use that to buy something, and so it's actually money. So they can, it's a similar idea now. They create money out of thin air by creating loans. And that's, again, fractional reserve banking. So nowadays, people usually write checks or even past that and don't actually take out cash out of the bank anyways. So this is just getting at the idea that basically there's even less worry about everyone trying to get the actual physical cash out of the bank anymore, because most people pay for things electronically or write checks. So again, there's very little chance of a lot of people coming all at once, although it can happen. It sounds a bit, some people might be a little bit uneasy that they do this type of thing because it sounds like some kind of a pyramid scheme or some kind of a Ponzi scheme. It's actually quite different, but you could but if you just think about it, it's kind of inefficient if you don't do it, because especially when you think of the Goldsmith example, you have this gold sitting there doing nothing. And so if the reserves were 100%, so that means that the Goldsmith would not issue any more receipts than what is in gold in a safe. They're not going to make any money. But if no one's ever going to come get it all at once, why not boost economic activity through providing loans? Especially if the bank or the Goldsmith, whoever's making the loan, is prudent and does their homework and provides loans to people who are likely going to pay them back and use them, say, for small businesses. That's going to generate a lot of economic activity. It's a very positive thing. It would kind of be very inefficient not to do that. But of course, if they're being irresponsible and just loaning money out to everyone and not caring if they pay it back, then you could get into some issues. But for the most part, it does make sense to have this kind of a system, because it's more efficient and it can create a lot of opportunities. So we're going to go through this process just by looking at a simple balance sheet. I don't like accounting. I'm not an accountant at all. So don't worry about how deep the accounting is going to be here. It's not. It's pretty straightforward, but it's a good way to illustrate the idea. So balance sheet has an asset component. Simple. All it is what a company owns or what is owed to it. So if you're a company and you have a truck, say you're a painting company and you have a truck, the value of the truck is an asset. If you've done a bunch of painting jobs and a lot of people owe you money, so you have accounts receivables of value, that's an asset. So any type of financial contract, I guess you could think of, where you have claim to money from someone else, that's an asset. So that's on the left side of a balance sheet is your assets, okay? And then liabilities is on the right, and a liabilities is what the company owes. So if you have more assets than you do liabilities, then your company has some net worth, or sometimes this is called equity. So that's the main view of what a balance sheet is. It's just this simple idea of looking at assets and liabilities and the difference. So let's look at a bank's balance sheet. So here we have the net worth of Seymour Bank. We're saying its net worth is $20,000. If we look at the asset side, we have reserves. So remember, this is a bank, so it takes in deposits. So it's taking in cash. So the cash in the vault is the reserves. That's $10,000. That's certainly an asset. Loans to customers. So when it makes a loan to people, it has a claim on them to pay that back. That's an asset. So if money can come to you, that's an asset. And in this example, they've bought some securities and some fixed assets. So they went in and bought some stocks and they bought some bonds. Fixed assets are bonds. So that's their assets. Now, what are their liabilities? Well, they're a bank, deposit money, and when they deposit it, they open up an account for them, and they get a credit on in their checking account of the amount that they deposit. That's a liability of the bank. So the bank is liable for these demand deposits. You know, if you have some money in your checking account, is money the bank, that's yours, right? Not the bank's. So in this case, if we take the total assets and minus the total deposits, we would get $20,000 in equity. And you notice that both sides must be the same, of course. Like this is your total assets, this, and then this and deposits is your assets minus your liabilities, right? Which are the demand deposits. And so since we're putting the difference here, plus that has to equal that, right? It's just a simple algebra application of algebra. There's this thing called the target reserve ratio. It used to be a required reserve ratio. So before, the government had a requirement that banks had to keep on reserve a certain percentage of their deposits, but not anymore. And so we just call it the target reserve ratio, or some textbooks will call this the desired reserve ratio, because the banks are free to choose what the reserve ratio is. And this is simply just the portion of deposits that a bank wants to hold in cash. So if it's 10%, that means if someone comes in with a $100 bill, the bank will want to hold on to 10% of that, which is $10, and it would lend out the rest, the other $90. Target reserves then are equal to the target reserve ratio times demand deposits. So again, in my example, if someone comes in with a $100 bill, and the target reserves would be $10 because they only want to keep 10% of that $100. So the reserve ratio would be 0.10 times 100 gives you 10. So let's suppose that the reserve ratio is 10%. Let's look at the balance sheet again here. So in this situation, we have that the bank has $100,000 in demand deposits. And so if it wants to hold on to 10% of that, what would its target reserves be? Its target reserves would be $10,000. What are its actual reserves? $10,000. So in this case, we would say this bank is fully loaned up, or it's right where it wants to be. Its target reserves are equal to its excess reserves. And so this bank here has no excess reserves. Excess reserves are reserves in excess of what the bank wants to hold as its target reserves. So in the last example, there weren't any because the target was equal to what they actually had in reserves. Excess reserves are equal to the actual reserves minus the target reserves. In the last example, these numbers were both exactly the same at 10,000. So now let's suppose that there's a new deposit of $1,000 at this bank. How do we do the accounting for this? Well, on the asset side, reserves are going to increase by the $1,000. So that person's going to come, think of a person going into the bank with a $1,000 bill. The teller's going to take it, put it in the till, and it's going to go in the vault. So that's an asset on their part. It's a $1,000 bill. None of this other stuff's going to change. We didn't say anything yet about them making a loan or buying any securities or fixed assets. So we have this increase in reserves. We know something has to change on the other side to balance it out. So demand deposits increase by 1,000, and that's clear when we know what a bank does. this person's going to, in return for this $1,000 bill, they're going to get a credit entry in their checking account. Okay, and that's a liability to the bank. So here now we have the total assets is 121,000, but the total liabilities and equity increased by the same amount. It was just because of this liability. So here you have the asset increasing by 1,000 and then liability increasing by 1,000. There's no change in equity or net worth for this simple transaction at this point. So we haven't really created any money yet. Now let's look at the target reserves. I think we should, so now, just going back, if we look here, the bank has a 10% reserve ratio, desired reserve ratio or target reserve ratio. So its deposits are 101,000. 10% of this is 10,100. Okay, so that's how much reserves it actually wants to have. If we go back, we see that it actually has 11,000. So it has excess reserves now of 900, and it would like to lend that money out. So nothing's changed yet here. So again, banks use excess reserves to make loans. Loans are eventually deposited. That's where you create new money. And then this process will continue until there's no more excess reserves. So we have another multiplier process. It's much different than the government spending multiplier or the, I also called it the respending effect when we were talking about, before when we were talking about the Keynesian cross model. You had that multiplier, but this is much different, but it's still a multiplier because you have sort of this, this is like a reloaning process. And so let's think about what's going to happen. Let's just think about it, just talking about this in general. So suppose this $900 is lent out to another customer at the bank. Well, when they make this loan, they're going to be crediting the demand deposit to make that loan. So that's going to increase this. So if they just lend this out immediately, that still doesn't make things balance out in terms of the actual and target reserves. They'd have to make quite a few loans. If you just think about the same bank and then just making loans, and let's just say all the money stays in the bank, and this is going to go on for quite a while before you get that the total demand deposits will be the same as the actual reserves. So just think about it, like if they make a loan for 900, then this is going to go up by 900, then you multiply that by 0.10, you're still going to get more than what's in the actual reserve. So you have this whole issue. But it depends on what's going on. So you could have someone, they could make a loan, but then that person could withdraw it and then deposit it at another bank, or they could spend it, and then whoever say they bought a car or something like that, then whoever sold the car is going to get that money. They might deposit it in their bank. So a lot of times we think of just the whole banking system as a whole and what that money's doing. So let's continue though with this example. Let's continue with the money multiplier process here in a table. So this is it's another example. Here the reserve ratio is 20%. And then we have a new deposit of 100. So let's go through this whole process. So the banking system as a whole can create deposit money whenever it receives a new deposit. And so again, we're thinking about the whole banking system. And then I'm not sure if they're not very, I think think of this new deposit, this $100 as perhaps money that wasn't in circulation, and then so it's a new deposit into the banking system. Well, actually, let's just, for now, all we need to consider here is this is a new deposit into the banking system. So it's not like another bank just made a loan. It's just, maybe you could think of someone had a $100 bill under their mattress for 5 years, and they're bringing it in to deposit it. And their first bank, the bank that they're going to go to is TD Bank. So that's the first bank here. So this person takes their $100 bill from under their mattress, goes to TD Bank, makes a deposit. Now the bank will have now excess reserves because they only want to keep a portion of this. So their deposits are going to go up by 100. You multiply that by 20%, and you'll get $20. So they only want to hold on to $20. The excess reserves then would be 80, want to lend that out. So now let's suppose they made a new loan of $80. So now there's a new loan of $80 and that somehow gets deposited into another bank. So the customer, a customer here at TD Bank got a new loan for $80, then they spent it somehow, and whoever they bought from now has that money and they deposit it into the second bank. Well, this bank now has a new deposit. They only want to keep 20% and loan out the rest. Now, this second bank loans out the rest, the $64, that somehow or other is going to go into being deposited at another bank. Again, we're making an assumption here that there's no cash drain. So we're basically saying that banks will always fully loan out their excess reserves and there's no cash drain, meaning, if this person doesn't keep a bit in cash to hold on to, and you throughout the whole process, you get a lot of people just holding on to some of the money. We're saying that none of that's happening because what we're after is, so when we're talking here about this multiplier, this is a multiplier for the maximum possible increase in the money supply. Okay, so that's what we're talking about when we're doing this process. So you can clearly see again that this in the third round, this $64 here becomes a new deposit. That bank only wants to keep 20%, the rest gets loaned out, etc. So the process goes on for quite a while. So if we look here, the total for the first 10 rounds would be given here. So for the first 10 rounds, we had 446.33 new deposits made, 357.07 of loans, and then 89.26 of addition to reserve. So this is all from the initial 100. So in the end, the total for the banking system here would be that new deposits would increase by 500. And again, what do we consider money in M1? Well, we consider it demand deposits. So we've increased the money supply here. So if you don't include this initial $100 would have been currency, if it's someone's cash under their mattress, then it's really not new money. Like it's still part of the money supply, right? Because it would be considered part of M1 as currency in circulation. But there's 400, new loans that were made that were deposits as well, they're deposits as well. So would be the new money. If this $100 came from the Bank of Canada, so it was never in circulation to begin with, then this $100 would also be part of would be new money to the money supply, right? Because it would have been not in M1 at all before. So anyways, this is the whole process. So the multiplier then is simply just this end result here, the total new deposits divided by if you look at 500, and this is the end result, this is the initial result, 500 divided by 100 is equal to 5. So that's the multiplier. You can calculate it by just taking 1 and dividing it by the target reserve ratio, which is 0.2. And if we do that, we get 5. Same thing. So the increase in total deposits that would occur in the whole banking system as a result of a new deposit in a single bank is equal to the money multiplier, which is the change in deposits over the change in reserves. Okay, so in the last example, it was a change of 500 with respect to just a change in 100. Again, you can calculate it by just doing 1 over the target reserve ratio. Okay, so let's assume that a nation's banking system is over-reserved by $20 million. So that means that if you take the reserve ratio, and again, we're assuming that all the banks have the same reserve ratio, or we can maybe think of the average reserve ratio. So we're saying then that on the whole, if you were to multiply the reserve ratio by the demand deposits, that amount that you would get would be their target reserves. And if you compare that to all of their actual reserves, you would see that they're over-reserved by 20 million. So it's asking, what is the value of the money multiplier? And what is the maximum possible expansion in the money supply if the target reserve ratio is 10%? So does someone want to calculate that? That's right. So what do we need to do with this question? Well, we want to calculate what the multiplier is. The multiplier is 1 divided by the reserve ratio. So 1 divided by 0.10 is equal to 10. So then we know that this 200 this 20 will blow up into 200. 20 times the multiplier, which is 10, equals 200. So the multiplier is equal to 10. So the total possible expansion would be 20 times 10 equals 200. And again, let's just go back for a sec to that slide. It's telling us this total new deposits. Okay. It's also including this initial one. So don't get too caught up into that, but I probably won't ask a question that you'd have to worry about on a test. But this question's asking and saying the money supply. But the money supply really didn't increase by this because it depends on where this new deposit's coming from. If this is coming from the Federal Reserve, the Bank of Canada, then yes, 500 would be the new increase in the money supply, because then this initial deposit wasn't already in M1. But if this is coming from being under someone's mattress, then it's already in M1. So the increase in the money supply then would only be 400. You would subtract this initial deposit off because it was already part of the money supply from the total new deposits. So that's just a point to keep in mind, because this question says possible expansion in the money supply. Well, I can't really answer that because you don't know what that additional $100 was. It already part of the money supply, or is it new money from the central bank or something like that? Or, if it wasn't in circulation. So I guess I'm not sure if someone holds their money under their bed for 20 years, I'm not sure if we would consider that as part of the money supply. So in that case, maybe this would be. So anyways, they're assuming here that that's new money, and all those new deposits are, including the initial one, are part of the money supply, or an increase into the money supply. So now if the reserve ratio was 2% instead, what would the number be? So, well, in this case, it'll be a little more. So what's 1 divided by 0.02? How times does 0.02 go into 1? Okay, so times. So in this case, the multiplier will be 50. So this is the reserve ratio. So the lower this number is, the lower amount that the banks will want to hold on to. So the more loans they're going to make, right? So when the reserve ratio is lower, that means the multiplier will become higher. So in this case, it's 50. So we would do 20 times 50. It would be 1,000. If the reserve ratio was 5%, then it would be, I'll let you guys figure this out. So in this case, the multiplier is going to be 20. 20 times 20 is equal to 400. Okay, and the process also works in reverse. If the bank is under reserved, in that case, we're going to say they would call in loans, which would decrease deposits. So we won't get into the legal issues of this. I don't think this is done, in the real world, this probably isn't done that much, right? I've never heard of a bank calling a loan, but they could potentially do this. It's probably in the fine print in the loan contract that no one reads, but they might be able to call in the loans. I'm not sure how successful they would be at doing that, but we're just trying to get the concepts here. So we're just going to assume that you can do this. And so this whole process just works in reverse. If they're under reserved, then instead of making loans, they call in loans, and they're going to need to call in a lot more loans to be able to get back to that being equal, their target versus their actual. And so clearly the size of the multiplier is related to the bank's target reserves. So the higher the desired reserves or target reserves, the lower the multiplier, right? Because they're holding on to a lot more money whenever they get a deposit than, if they were to decrease their target reserve. So the higher if the target reserve was 100%, then there wouldn't be a multiplier. Now this multiplier too will be reduced if people tend to hold more of that in cash along the way, right? So I guess you could think of, you got a loan to buy a car, but every one of those loans going through that process, maybe they're holding part of it $100 in cash every time or something like that. So then in that case, a lot of each round of that multiplier, a lot of money's not being deposited. Some of it's being drained away. This is usually called cash. And banks won't necessarily make loans if they can't find credit-worthy loan applicants. And so this is typically an issue when you're in recessions that the Bank of Canada will do things, and we'll talk about that in the next lecture, but the Bank of Canada can do things to increase the reserves at commercial banks. The idea is they want to stimulate the economy, but they don't have the Bank of Canada can't control that. It's the commercial banks themselves that make decisions about loans. So the Bank of Canada can only just sort of do things so they have a lot of excess reserves, and hopefully they will make more loans, which will increase the money supply and stimulate the economy. But they don't have control over that. And if the banks aren't making any loans because they can't find anyone to make a loan to, then that's what happens. And that would be more likely to happen when you're in a recession, right? Because there may not be as many credit-worthy loan applicants. People are going to be buying less things that they would need a loan for as well. And then there's going to be a lot less people with jobs because a lot of people lose their jobs. And so, there's typically a reduced demand for loans during a recession. So that's the main concepts in this chapter. So, it's pretty straightforward. We have so you need to remember the functions of money. Those are three things. They're very different than what the characteristics are. There's 5 characteristics. The most important is acceptability. You have the idea of the Goldsmith issuing promissory notes. That's the main idea. I'm sure there's more to it, but for the purposes of this course, that's the main idea, just to get the basic concept of how banking originated with Goldsmiths. So it's important to just understand that idea of the promissory note or receipt. That's actually what money is. And we've evolved. We have fiat money, and basically there's nothing. It doesn't have our currency doesn't have any intrinsic value. It's not backed by anything, but we all accept it, and so that makes it work. And we reduce all of those inefficiencies that would occur if we didn't have money and had to barter. We have our basic definitions, categories of the money supply here: M1, M2, M3. Their relative sizes. Make sure you know what fractional reserve banking is. We just looked at the balance sheets here to show sort of basic transactions. Now I probably should add. So we're going to do this in class exercise, but let me just see what you think. So we know now that this bank would have excess reserves of 900, right? Remember this? What would happen to this balance sheet if they made a loan of $900 to one of their customers? What would happen? And then that customer kept the money in. So in that case, they would make another loan, right? And what are they going to do when they make the loan to the other customers? They're going to credit their checking account or demand deposit. So now demand deposits would be, 101,000 plus 900. So we would be at 101,900. If we multiply that by the reserve ratio, we get 1019. And so we're still over reserve. And so they would have to keep, only if everything was just within this bank, they would have to make how many loans so that their target reserves would equal their demand deposits? Well, they would have to make the full amount of the multiplier being applied. So in this case, we had the initial deposit being 1,000. The money multiplier is 10. So they would have to make loans of $10,000, and then they would have to make loans of 9,000, and then they would have if they made $9,000 worth of loans, then they would have demand deposits of 11,000. And so then if we took 11,000 multiplied it by 0.10, then we would get that their target reserves would equal their actual reserves at 11,000. So someone has a question. Everyone can read that, right? So if we have a balance sheet and it asks us to change one figure on the balance sheet to reflect the bank achieving a 5% target reserve ratio, would we multiply the demand deposit number by 0.05, which is the target reserve ratio, and make sure that the number we get is the same as and that's exactly what I was just doing there. And if it's not, then that's the number we change to reflect the 5. Yeah, that sounds right. Yep, that's right, Paulina. So we're actually going to do an in-class exercise now. So when there is a new deposit, you just add it here. So if there's a new deposit, so if the bank lends this $900 out, they're going to make a new deposit, because when you get a loan, that's what happens. The bank credits your checking account with the amount of the loan. But on the left-hand side, no changes to reserves are going to happen, but you're going to be increasing the loans to customers. So that's how both sides would balance. And we'll do a question where we do that. In the in-class exercise, we'll do something like that. So can everyone see this okay? I'm sure what everything looks like on your end. Okay, good. So in this example, we have the current balance sheet for the Maple Leafs Bank. Answer the following questions, assuming that the bank's target reserve ratio is 5%. So the first question is the bank over or under reserved, and by what amount? Okay, so how do we do that? So what's the first thing we want to do? And we're looking at this thing first. So what are the demand deposits? This amount. So how do we know what their target reserves are? What do I put here? Anyone? Just type it in the chat. Give you a sec to think about it. Not yet. So how do I get what this bank wants in terms of the target reserves? Yep, that's right. So 0.05 times 1 million. And that's going to equal $50,000. So 50. Okay. How much are their actual reserves? 100K. So are they under or over reserves? Yeah, they have excess reserves in the amount of excess reserves, put EX for that, is the actual reserves minus the total reserves, and we end up with 50,000. Everyone good with that? So that's the answer here, 50,000. Now it says, suppose that a loan in the amount of the excess reserves found in A is made to Sats Mundine. Show the resulting balance sheet in column 1. Okay, so what's going to happen to reserves? So is there any money leaving here yet? Okay, so this is going to stay the same. Now, we know this is going to change because we're told they made a loan. So they made a loan for $50,000. So now this is going to become 70,000. I'll just put 70 because that's the best I can do for drawing with this thing. I'll see if I can reduce the. That's better. Letting me delete them, so I'll just move them out of here. So we're gonna. Oh, what happened? Okay, so let's put the solution up here because I had that put in. So, and let me go back to that pencil. So there's no change. This is going to go up by 50K, right? They made a loan for 50K. Now, we're not talking about security. They didn't buy any of these, so it stays the same. So this side increases by 50,000. Now, demand deposit. Oh, sorry, this is this up. Sorry, here. Okay. So this is going to go up by 50,000. These don't change. Now, what happens over here? Well, they basically deposited 50,000 in that person's account. So this is going to increase by 50K. So I'll just put plus 50. And so here we're going to end up with 1,050,000. Okay. And then this didn't change. So here will equal 1.3 million, which is the same what's on the left. Okay. Is everyone clear on that? So all that happened here was the bank made a loan in the amount of the excess reserve to one of its customers, but the customer hasn't left with the money yet. They haven't withdrawn it. They're still at the bank. So now in the next part of the question, it says, suppose that Sats immediately spends all of his loan by writing a check to his psychologist, Frida Freud. She deposits it in her bank account, which happens to also be at the Maple Leafs Bank. It's saying, by how much is the bank now over or under reserve? Okay, so the bank balance sheet is going to still look like this, right? And then on the right here, we have this here is 1,000,005, right? We're going to bother writing that, it's 1,000,005. So now this person's already at the bank. So basically, what's gone on here? This person basically, wrote a check to another customer of the same bank and transferred the money. So did anything really change here? Oh, nothing. There's just the change in the composition of the accounts. Okay. So we're going to still have one. I'm going to have 1, 0, 0, and then 50, right? We're just adding the 50,000 there. Demand deposits hasn't changed. This side's going to equal that side. So we just added 50,000 here and 50,000 there. The question's asking though, how much is the bank now over or under reserve? So how do we figure that out? Well, we take the 0, 5, and then what do we multiply that by? Anyone want to type it in the chat? Is this a text tool? Oh, beautiful. Okay. 0.5 times 10500. I'll put the commas in. So it's $1,050,000. And so if we work that out, what do we get? And this is 0.05, sorry. It doesn't let you, this is 0.05. Yeah, so the answer here is going to be 5,500, okay? And so it's going to be, is it over or under reserved? It's over reserved, right? So our target is 52,500. What are the actual reserves? 100,000, right? So what is the amount that the bank's over reserve? 475. So actual reserves minus target reserves is equal to 100,000 minus 52500, which is equal to 47,500. Then it says next that, so it says next, suppose instead that the bank makes a loan in the total, a loan for the amount of your answer in A. So it's making a loan for $50,000, which then clears against the Maple Leafs Bank. Show the resulting balance sheet in columns 2 in table 811. So now what's happened is they made a loan to one of their customers, but they withdrew the money. Okay, so what's going to happen? So is reserves going to change now? Yes or no? Yes. So now the reserves are going to be reduced by 50,000. So we're going to have 50,000 for reserves. Okay, they did make a loan, right? So the loan is still on the books. So the loan is for the loan's for 50,000. So the total loans are going to be 700,000, right? Total loans, we're just adding 50,000 to 650,000. Okay, these are going to stay the same. And so what's the number going to be here at the bottom? Well, we know that when we had this, here we had 1.3 million. Now all we're doing is subtracting 50,000 from reserve. So this is going to be 1.25 million, right? So what's happening over here? We know on this whole side, we're going to have to reduce it by 50,000. And deposits, did they increase or decrease? Anyone? So when this person withdrew their money from the bank, what happened to the amount in their checking account? It fell by 50,000. Okay. So our demand deposits, and actually we're over here, demand deposits are going to decrease by that amount. So we had that initially the money would have went in here and it would have increased the demand deposits by 50,000. And then when the person withdrew the money, it's just going to go back to where it was before. So this here is going to be the same as before, $1 million. Okay, that's the same. And so down here, we're going to get 1.25 million. And so again, both sides now are balanced. Okay, so now how much excess reserves does the bank have? So basically, we had the deposit, we had the initial being over reserved by 50,000. And so the story goes like this. Someone came in, deposited $50,000, and then they made initially they're over reserved. We don't know why. They're over reserved by $50,000. They make a loan for $50,000 and someone withdrew it. Okay. And so now we're asked, what's the target versus, are there any excess reserves? So what we do is take our 5%, multiply that by the 1 million, like we did before. That equals 50,000. And what do we have in for our actual reserves? Our actual reserves are equal to 50,000, right? And so target reserves minus actual reserves is equal to 0. Again, just to be clear, this is equal to your target reserves. Okay, so there's none. But I mean, this money will get deposited probably at another bank, and we could still get a big increase in the number of new deposits, just not at this bank, if we're thinking of the whole banking system. And so the next part of the question actually talks about the whole banking system. So it says, now suppose that there are 9 other banks in the economy, so there's 10 in total, and the balance sheet for the whole banking system is presented in 8.12. You can assume that each of the other banks also has a target reserve ratio of 5%. So we all have a target reserve ratio of 5%. Okay, and the question now says, show the balance sheet of the banking system when it is fully loaned up. So that means that if there are, we're going to see that this banking system has excess reserves. And so fully loaned up means that all of those excess reserves are going to be loaned out. So we're going to go through that money supply process. Anytime there's excess reserves, we're making the assumption that the bank would lend it out. Anytime there's excess reserves, lend it out. And so when that whole process ends, we say that it's fully loaned up. So how do we figure this out? So first of all, we need the target reserves of the whole banking system. Well, that's equal to 0.05 times, what's the number? You can type it in the chat. That's right. So we're going to multiply that by 10 million. Okay. And so that should equal 500,000. Am I right? Anyone want to confirm that? So 0.5 million, which is 500,000. Okay. So that's what our target reserves are. What are our actual reserves? They are, perfect, thanks Healy. And the target reserves are, the actual reserves are $1 million. Okay, so then our target is 500,000. We have actual of 1 million. So we have excess reserves with, so excess reserves are equal to actual reserves minus target reserves. And that equals 1 million minus 0.5 million, which is 500,000, which is equal to 500,000. I'll just put the 500,000. So that's our excess reserves. So now this is just like a question we did in the slides. Now we know that the banking systems has $500,000 of excess reserves. We know their reserve ratio. So what is the money multiplier? You want to tell me what the multiplier is? Yep, it's equal to 20. So 1 divided by 0.05 equal to 20. And so if we take our excess reserves, 500,000, and multiply that by 20, we get 10 million. So that is how much the total new deposits will be. Okay, so basically we're going to have on this side, our deposits are going to increase by 10 million. So now we're going to have 20 million here. Okay, and then reserves, nothing changed here, but how many loans did we make? We were going to make $20 million in loans. So this is going to be 1, 2, 3. And so both sides here increase by 10 million. Oh, sorry, by mistake. It's 10 million, not 20 million. So this side is going to be 16.5 million. Okay. So basically, again, we're just adding 10 million in terms of loans and 10 million in terms of deposits. Okay. And so both of these sides will balance out at 22.5 million. Now it says, so that's what the balance sheet would look like if it's fully loaned up. And then it says in G, what is the increase in the money supply as a result of all the banks becoming fully loaned up? So we're just going to say $10 million. That's the total possible increase in the money supply. Okay, now it's asking us to return to the balance sheet in table 812. Okay, so returning to the balance sheet in 8.12, what would be the consequence of the economy's central bank imposing a 12.5% required reserve ratio on all banks? What amount of loans would have to be called in? So now, if that were the case, required reserve ratio, but everything's still the same, we need to know if they're over or under reserved. So we need to calculate the target reserves. So the target reserves now will be 0.125 times. From my recollection of this question, they want us to just go back to the initial point. So we're going to assume they have $10 million in deposits. Okay, so 0.125, 10 million is equal to how much? Anyone? So that's 1.25 million, right? Yep. What are their actual reserves? Well, their actual reserves are only how much? 1 million. And so our excess reserves are 50,000, right? Now, what's the multiplier? I'm going to divide that by 0.125, 8. Okay, so we're going to take that 8 and multiply it by the 250,000, and that's going to give us how much loans they're going to call. So this is the multiplier working in reverse. So instead of calling loans, we're going to need to, instead, usually up to now we've been looking at making new loans, but now we're sort of destroying loans. And we're going to have to destroy an amount, a multitude of the initial access reserves. Actually, and so I kind of should have put a negative here. So our access reserves here are actually negative. Okay, so I can't really add that here, but just, for your notes, make sure you remember. So here we're under reserved by 250,000. Okay, and so we're going to need to call in an amount of loans, a multitude of 8 times higher to be able to get this so that our target and access reserves will be back to being equal. Okay, so we're going to have to make call 8 times 250,000, and so that's 2 million. So I have 2 million in loans would need to be called in. Okay, so let's see if they were able to do that, what would their new demand deposits be? If they called in $2 million of loans, we know on the left-hand side, they would have $4.5 million in loans, and the demand deposits then would have to reduce by that amount. And so we would be left with 8 million. Okay, so if we do 8 million times 0.125, we will get 1 million that they would need in terms of the target reserves. And so that's actually what they have in reserves. So then they wouldn't have either be over access reserved, right? I'm just confirming that $2 million of loans would need to be called in. If we call in $2 million in loans, then when we calculate our target reserves, it'll equal our actual reserve, which is what it should be. Okay, are there any questions on that? Okay, and I know, Paulina, you had a few questions, so we're getting a bit late. But maybe if you have a few quick questions. Sorry, I didn't realize that we went this far past our usual time. I was hoping to end a bit early so I could field any questions, but go ahead if you had any questions, Paulina.
I was going to go on the speaker. So you answered 2 of them, one of the ones I typed out, and then another one going through this example. And then I think the other ones will have to do with Chapter 9. So maybe I'll wait until Friday when you review it. And then as you go through, maybe I'll ask questions.
Okay, perfect.
Yeah, I think, I'm good. Other than that, the 2 that I wanted, what you answered today. So that was great.
Perfect. Great. Sounds good. Okay. Yeah. Just, hopefully we'll not end up going this long into the class time, and then we have some time to answer some questions on Friday.
So thank you.
Oh, and I forgot to ask, so the midterm, were there any comments on the midterm? You could type in the chat or just talk in your mic. I think it went quite well. I think the average was fairly reasonable. I'm glad to hear it was fair. I try to make fair exams all the time. So I'll take no comments as a good thing, because usually if they're bad, I hear them very quickly. So, okay, that's great. So we'll call it a night, and we will see you bright and early on Friday morning. Oh, someone had Michelle. Oh, yeah, Michelle, about the national mixed income. Maybe just send me a separate email on that one, and I'll get back to you on that one. Let me. You send an email. Let me get back to you on that one. All right. Great, everyone. Sounds good. And we'll call it a night. Have a good night and take care.